Hi everyone, welcome to the part 3 of the RM training session on SCF product fundamentals. So in video 1 and 2, we have built the foundation, that is we have discussed about the three financial statements, the key ratios and also your working capital matrices, which is your DIO, DSO and DPO, and the cash conversion cycle. I'd also briefly told you about the products which we can pitch through the gaps. Today I will go deep into these funding gaps and also give a walkthrough about the TReDS and dynamic discounting checklist, like what to look for a client's financials before you pitch these products. Let's go. So let me give you the complete decision framework, that is the product matching table. So this is what you should be running in your head every time you look at the client's working capital ratios. Okay, so if there is a high DSO, that is the days sales outstanding, say something which is more than your 60 days in a MSME's balance sheet, okay, MSME seller's balance sheet actually, right? So what does it tells? That the receivables of this MSME seller is stuck, and that is why the seller needs an early payment, right? And the SCF product which fits this requirement is either your TReDS or invoice discounting. Okay, and so as I discussed, who will be the key qualifier? It will be a MSME seller plus a rated buyer on the platform. Okay, next we go to the DPO days, that is your days payable outstanding. If it is high, say more than 60 days in a MSME or a non-MSME's buyer's book, right? It should be buyer's book. Then we know that the buyer is stretching its payables, right? And that will make the supplier in distress. So it is actually using the supplier's money to stretch its working capital. Now what happens when you stretch the payment to the suppliers? They very intelligently add back that cost to the COGS, and that hits the buyer, right? So the SCF products which will fit for these buyers will either be dynamic discounting if the buyer is cash rich, or will be a TReDS product. Okay, now who will be the key qualifier? There should be a strong buyer balance sheet, a strong buyer with a good balance sheet. Okay, now coming to the next parameter, which is your days inventory outstanding. If it is high, say more than 45 days, we tell that the cash is logged in inventory. It might be because of a seasonal buildup, or maybe the inventory is not moving very fast. Okay, so what are the products that which can be pitched? So either our inventory or a channel finance, and the key qualifiers will generally be your distributor or the dealer network, right? Now when we combine all these three parameters which I had discussed in my previous video, we get a cash conversion cycle. So what was the formula? It was days sales outstanding, DSO, plus days inventory outstanding, DIO, minus days payable outstanding, DPO, and we get a CCC, which is your cash conversion cycle. Now if this is more than 90 days, I tell that the entire cycle is stressed. Okay, the entire value chain is stressed. There is a working capital requirement for this buyer or seller. Okay, and that is where we can pitch the entire SCF program, both for the vendor side as well as the buyer side. Okay, so any programs like your, say the supplier finance or the dealer finance programs for a particular company, fine. And if the CCC, the cash conversion cycle, is low, or negative. Then we know that the buyer has high cash on the balance sheet. It has high liquidity on hand. Okay, and what is the product that which we can pitch to this buyer? That is your dynamic discounting, where the buyer can use its treasury funds to generate extra income, which we call as the arbitrage income. Okay, now the key qualifiers mostly are in the business of FMCG, in the sector of FMCG or the retail businesses, right? Okay, so now let's go through the TReDS onboarding checklist. Okay, so use the buyer's financials to pre-qualify the TReDS product before you even pitch to them. Okay, so the first thing which we check is the accounts payable, right? So this you can find where under the balance sheet, under your current liabilities, right? So every company now has the compulsion to give the MSME outstanding as well. So there will be two bifurcations under your current payables. So one is the outstanding for the MSME suppliers, the other is outstanding or the trade payables to the non-MSME suppliers. Okay, so when you check in the balance sheet that there is a huge MSME supplier outstanding, you know that this client requires the TReDS product, right? Now it need not necessarily mean if there is a less or a lower MSME payables on the balance sheet that the supplier, or sorry, that the buyer is not a good suitable or candidate for the TReDS product, because it can happen that the buyer might pay on the last day to its MSME suppliers. It doesn't want it do not want to show the outstanding on the of the MSME suppliers on its balance sheet, and it might clear all the dues, right? But if there is a huge or a significant portion of its payables under the MSME supplier outstanding, we know that yes, it's a good company for TReDS. Okay, next is your supplier base structure. So when I mean what do I mean by structure? That a huge or significant percentage of the vendors or the suppliers is, say, MSME, because the TReDS platform is for the MSME vendors or suppliers. But if a company does not have a large MSME say suppliers, then it might not be very suitable. The company or the buyer might not be very interested to get onboarded on the platform, because it will not help much. Okay, next is your, say, credit rating strength. Fine. So if you have a higher rated buyer, what happens is the banks, they check these credit ratings, the external credit ratings, like your company can be a triple A, double A, or triple B plus. Okay, so basis these external ratings, the financiers they give a particular discounting rate to these buyers to discount the MSME bills, MSME suppliers bills, right? So it will help those customers more where the credit rating is higher, right? Next is your cash flow from operations. Of course, we need to check cash flow from operations if it is positive or negative, because if it is negative, we know that the company doesn't have cash to repay its payments. So while the company comes on the TReDS platform, financier has given discounting to the MSME suppliers, but when it comes to giving back the, or when it comes to the repayment of this amount or the discounted amount to the financiers, the company might not be able to, because the cash flow from operations is negative, and that is a red flag. Okay, it might not be able to honor its repayments, right? Next we come to the liquidity position. So if the company's current ratio is more than 1.2x, we say that there's an adequate cash buffer. Okay, it might prevent settlement failures. Okay, next is your leverage ratios, the kind of debt levels the company has. Say your debt to equity is not more than 2x, which is generally preferable. Okay, then your TOL by TNW is not more than say 3x or 3.5x. Okay, because an over leveraged buyer may face what, liquidity crunch, right? It may face that it might not be able to give back the payments. Now, why it is more important for a TReDS platform? Because here the funding or the limits are unsecured. The financiers generally do not take any security against these limits. So it is very important that we understand whether the company is over leveraged or not, because when it goes into liquidity crunch, it will first repay those financiers where it has a security, right? It will not make its security like it will not want to sell its security because of repayment failures, right? So first it will save those security which are mortgaged or hypothecated, and then the next payments which will be happening is to the unsecured lenders, and that is why we need to be more careful here. Okay, and then the working capital cycle, as we said, if there is a high DPO plus there is it's a MSME heavy supply base, then it's a pure TReDS candidate. Okay, so next move to what are the checklists for dynamic discounting. Okay, so in the financial statements, in the balance sheet, again we will check if there is a large accounts payable balance. Now here in dynamic discounting, it need not be that it's only the MSME payables which are the volume is more, because it can also be a non-MSME supplier base. Here there is no RBI regulation for the dynamic discounting. So TReDS platform is a RBI regulated platform. There it is a mandate that the suppliers have to be MSME. So in dynamic discounting, it's the cash utilization of the company, the treasury funds utilization. Here it can be any supplier, whether it is a MSME or non-MSME. Okay, the second requirement is there should be high cash. Of course, if it's a dynamic discounting, the company has to have cash sitting on its balance sheet. Okay, there should be idle treasury funds at attractive rates versus the FD rates, because if they are coming on the dynamic discounting platform and they are getting the same rates as they are getting in the FD, then there is no use for the buyer to come on the dynamic discounting, like use this product. Okay, it can very well put its money in the FD and get the same interest rate, but if the arbitrage it gets is greater than the market returns or the FD rates, it is more suitable for dynamic discounting. It will be more interested to use this product. Okay, again we have strong working capital position needs to be there. That is, the current ratio should be greater than 1.5x. The net working capital should be positive. Okay, and buyer must not need this cash for its regular business operations. Okay, because if that is so, then the program might stop in between and the suppliers might suffer, right? Now also a buyer should have a low or no short-term debt. That is where we can say that there's a lot of cash sitting on the balance sheet, right? Because if there is a high short-term debt or high total debt, then the cash will be utilized to pay those debts, right? Next is diverse supplier base. So it best works in, say, pharma or FMCG companies like Dabur, then auto companies like, say, Rico. Okay, so and it should be a large fragmented supplier base. Okay, because when there are more number of suppliers, the product or the program can scale, and it helps the buyer, right? The next requirement is, of course, the payment terms with the vendors should be longer, because if a supplier is getting paid, say, in 7 days or 15 days or within 30 days, the supplier might not be interested in this program, because any which way it is getting the money in a lesser amount of days. Okay, so if only where the buyer is stretching the payable days more than 45, there the vendors will be interested to get into this program so that they can get the money early, right? Okay, so now let's go to the checklists for both the DD and TReDS. Let's do a combination where we want to sell both dynamic discounting and TReDS program. Okay, so the first requirement, as usual, is that there should be a large account payable balance, and it should be both MSME plus the non-MSME payables, because if one of them is negligible, then a combination of both is not very suitable, right? And also the supplier profile mix. Okay, the number of supplier base should be high, just not the volume of amount, right? Because if there are lesser number of suppliers, the buyer might not be interested to have a program, because for a buyer, managing a large number of suppliers is difficult, and that is where it will be going for a program where all its vendors are managed together, both the MSME and non-MSME, right? So here, if it has a good mix of, say, MSME and non-MSME, so the dynamic discounting can work for the non-MSME vendors, and the TReDS can work for its MSME vendors. So you give a full solution for its supplier side value chain. Okay, so next is, of course, the cash balance, and as well as the short-term investments on its balance sheets, because if there is a dynamic discounting, of course we'll need idle cash to be sitting on the balance sheet, right? Now also, if the short-term borrowings and the cost of capital are, say, high, then a TReDS works better, because it helps to reduce the buyer's interest burden, right? And if it's a low cost of capital, then of course the dynamic discounting helps, because it can give a higher yield than the FD. Okay, the next is your working capital cycle. Okay, if the days payables outstanding, say, is high, then you can convince the buyer to, say, here the vendors are getting the payments late. Okay, and then you can convince the buyer to utilize a TReDS platform to pay its vendors early, and that extra uh, cost that was coming on its raw materials on the COGS can be saved. Also, if the company is a very inventory heavy business, then there will be liquidity crunch. It will be very sensitive to liquidities. So here again, TReDS can help the buyer. Okay, so these are the different checklists that you can go through in the financials before pitching either, say, TReDS or the DD, the dynamic discounting product, or the other supply chain finance products. Right, so in video 3, we have covered the 3 funding gaps in the working capital cycle, right? The payable, the receivables, and the inventory gaps. We have mapped each gap with the SCF products, and then we have checked what will be the TReDS and the dynamic discounting onboarding checklists, right? So now we can understand that every SCF product does fill a specific gap in the working capital cycle, right? So in the video 4, we will cover important concept, which is the MPBF, maximum permissible banking funding, and the drawing power, right? And also I have told about these financial checklists that we can do. There are other non-financial due diligences which are required for a particular buyer that RM needs to check before pitching or before approaching the client. Okay, so see you in video 4. Bye.